Today's video is all about a bold market call from 𝗗𝗟𝗏, the head of research and chief investment officer at Fundstrat Capital. During a recent appearance on Closing Bell, 𝗗𝗟𝗏 said he believes the S&P 500 can grind its way up to 7,300, and he explains why earnings, positioning, and market rotations all matter right now. As you already know, I am going to play the clip of what 𝗗𝗟𝗏 said on CNBC, then I will break it down and share my own reaction and perspective on his outlook. After that, we will dive into an in-depth analysis of 3 stocks to buy and hold forever. If you find value in this kind of market insight, hit the like button, share the video, and let me know your thoughts in the comments. Make sure to subscribe so you do not miss the next important investing update. Now let's hear what 𝗗𝗟𝗏 has to say.
So you think we're going to 7,300 on the S&P in the near term?
Yeah.
So are we witnessing this slow turnaround for stocks to get back on track? What do you think?
Yeah, I think stocks took some hits. Partly was a software downturn, and then this rotation out of the Mag 7 armies into the bullet makers for AI, and a general sort of risk-off as gold surged. But the earnings have been delivered solidly. We've been getting good economic reports, and I think positioning has gotten risk-off enough that we can sort of climb maybe in a labored way towards 7,300.
Hey, how about that? Do you think, we talked about this at halftime today, are we appreciating enough how strong earnings season has been?
I think the stocks haven't reflected that because we've had a huge beat, a large percentage of companies beating. It has shown up, I guess, in small caps, but to me...
Yeah, but I mean, you know what I mean? It's like, if you said we were going to do double-digit earnings growth, and that would be a key pillar of the narrative as to why stocks were going to continue to go higher, and then we had all this volatile chop, and we're not sure now where we're going. You just said, well, if we're going to do that kind of earnings growth, we're going to be just fine.
Yeah. I mean, there's this old adage that it takes a whole lot of E to offset PE, meaning, like, you're right, the earnings have been good, but things that have affected multiples are what's causing the market to come in. The AI, a new Fed chair, potential war. So you're right. I think the fundamental anchoring is actually good. So that means stocks eventually kind of re-anchor to that and we go higher.
So you say there are 3 key trades: rotation back to the Mag 7, the IGV bottoms, that's software, and crypto bottoms. But you're not suggesting that those 3 items have happened, are you?
Not yet, but we're maybe 90% of the way through that because I've seen some of the positioning data. So we know on for instance, prime brokerage, Goldman data, software ownership is like multi-decade lows. And then we know that the Mag 7 have gotten cheaper than the bullet makers, which has never happened in 10 years. They're 3 PE points discount. And then, of course, on the crypto side, we've already gotten to drawdowns that are basically 80% of what's been in past crypto winters. So I think those are setting up to be really big trades. Maybe they've led the market, so they bottom first and they'll start to rally even if the market's peaking.
Does NVIDIA earnings 1 week from today hold the key to the whole thing, just given the fears about AI and the spend? And we need to get the results. We need to hear from Jensen Huang.
I mean, that could set the bottom because, like if you look at the software index, this is like the 8th week of a pretty severe downturn. So next week, as you know, sometimes 9 is a big number, turning point. That could mark the bottom for software.
After watching this interview, the first thing that really jumps out is just how confident 𝗗𝗟𝗏 is in his near-term target. He straight up says he believes the S&P 500 can reach 7,300 in the near term. That number is not subtle, it is bold. And what is important here is not just the number itself, but the reasoning behind why he thinks the market can grind its way there, even after all the recent volatility. Tom starts by acknowledging that stocks have taken some real hits. He does not sugarcoat it. He points to a slowdown in software, a major rotation out of the so-called Magnificent Seven, and into what he calls the bullet makers for AI, basically the infrastructure and hardware side of artificial intelligence. On top of that, you had a broader risk-off environment where money flowed into gold, which is usually a sign that investors are nervous. I actually appreciate that he starts there, because too many bullish takes completely ignore the pain investors have felt recently. This has not been an easy market psychologically. But then Tom pivots to what he sees as the real anchor underneath the market, and that is earnings. He makes the case that earnings season has quietly been very strong, even though stock prices have not reflected it yet. This is where I mostly agree with him. We have seen a large percentage of companies beat expectations, and economic data overall has been holding up better than many people feared. If you just looked at earnings in isolation, you would think the market should be acting a lot healthier than it has. Tom explains this disconnect using an old market saying that it takes a whole lot of earnings to offset changes in valuation multiples. In other words, earnings can be good, but if investors are nervous about things like AI spending sustainability, Federal Reserve leadership uncertainty, or geopolitical risks, then price-to-earnings ratios can still compress. That is what he believes has been happening. And honestly, that framing makes sense to me. We are not dealing with a fundamentals problem as much as a confidence and positioning problem. Where it gets more interesting is when Tom starts talking about positioning. He argues that positioning has already turned risk off enough that the market can begin to climb again, even if it feels labored and slow. He is not calling for a straight-line rally. He is basically saying this is the kind of environment where stocks grind higher while people remain skeptical. Personally, those are often the most frustrating but effective bull markets because nobody feels comfortable chasing them. Tom then lays out what he calls 3 key trades that could define the next phase of the market. The first is a rotation back into the Magnificent Seven. The second is a bottom in software, which he references through IGV, the software ETF. The third is a bottom in crypto. What is important is that he is very clear that these things have not fully happened yet. He thinks we are about 90% of the way there. To support that view, he points to positioning data from prime brokers, specifically mentioning Goldman Sachs data showing software ownership at multi-decade lows. That is a big statement. When positioning gets that washed out, it often does not take much good news to trigger a reversal. He also notes something pretty shocking, which is that the Magnificent Seven are now trading at a valuation discount relative to the AI bullet makers. According to him, that has not happened in over a decade. If that data is accurate, it strongly suggests the rotation has gone too far. On the crypto side, Tom highlights that drawdowns have already reached about 80% of what we typically see during full-blown crypto winners. His implication is that a lot of the pain may already be priced in. Now, I want to be clear with my own opinion here. Crypto can always go lower. It is volatile by nature. But historically, when drawdowns get that severe, the risk-reward does start to shift, even if timing the exact bottom is impossible. One of the most important moments in the interview comes when the discussion turns to Nvidia earnings. Tom is asked directly whether Nvidia earnings could hold the key to the entire market. He does not dodge the question. He acknowledges that this report could be extremely important, especially given fears around AI spending and expectations that are sky high. He also mentions that we need to hear directly from Jensen Huang because his commentary could either calm markets or add fuel to the uncertainty. Tom adds an interesting technical observation here, noting that software has been in a severe downturn for about 8 weeks. He suggests that week 9 often marks a turning point. Now, I will say this part is more speculative in my view. Markets do not reverse just because of a number on a calendar, but I do think he is highlighting something important, which is that sentiment around software and AI has gotten extremely negative in a very short period of time. When I step back and look at the full interview, my takeaway is this. Tom Lee is not saying everything is perfect. He is saying the market has already priced in a lot of fear, a lot of rotation, and a lot of bad news. Meanwhile, earnings and the economy are still holding together. If even a few of these fears ease, especially around AI and software, the market could re-rate higher fairly quickly. Do I fully buy the 7,300 target in the near term? I think it is aggressive, but I do not think it is insane. What I do agree with strongly is the idea that fundamentals are better than price action suggests, and that positioning extremes often precede reversals. At the very least, this interview makes a strong case that the market may be closer to a turning point than most people currently believe. Now let's dive in and talk about the 3 stocks to buy and hold forever. The first stock is Automatic Data Processing, ticker symbol ADP. Automatic data processing is one of those businesses that operates almost entirely behind the scenes, yet touches millions of workers and employers every single pay cycle. If you have ever received a paycheck, chances are ADP was involved somewhere in the process. That alone should tell you how deeply embedded this company is in the global economy. At its core, ADP is a payroll and human capital management powerhouse. It helps businesses handle payroll processing, tax compliance, benefits administration, time tracking, and a growing suite of workforce management tools. These are not optional services. Companies have to pay their employees accurately, on time, and in compliance with constantly changing regulations. That makes ADP's services mission critical rather than discretionary. What makes ADP so powerful as a long-term investment is not just what it does, but how hard it would be to replace it. Once a company integrates ADP into its payroll and HR systems, switching becomes painful, risky, and time-consuming. Payroll errors can lead to unhappy employees, regulatory penalties, and reputational damage. That creates extremely high switching costs, which is one of the strongest competitive moats any business can have. A DP also benefits from enormous scale. It processes payroll for hundreds of thousands of businesses across more than 140 countries. That scale allows ADP to invest heavily in compliance, security, and technology in ways smaller competitors simply cannot match. Payroll and tax laws change constantly, and ADP has the resources to stay ahead of those changes globally. This scale advantage reinforces its moat year after year. Another underappreciated strength of ADP is its float. Because ADP collects payroll funds from employers before distributing them to employees and tax authorities, it temporarily holds massive amounts of cash. This float generates interest income, which becomes an additional revenue stream, especially in higher interest rate environments. That is a subtle but powerful tailwind that many investors overlook. From a growth perspective, ADP is not a flashy high-growth tech company, but that is exactly why it works as a forever stock. Its growth is steady, recurring, and resilient. As employment rises, ADP benefits. As wages increase, ADP benefits. As regulations become more complex, ADP benefits. Even during economic slowdowns, businesses still need payroll services, which gives ADP a level of earnings stability that few companies can match. Financially, ADP has a long history of consistent revenue growth, expanding margins, and strong free cash flow generation. The company returns a significant portion of that cash to shareholders through dividends and share buybacks. ADP is also a dividend aristocrat, meaning it has raised its dividend for decades in a row. That kind of track record does not happen by accident. It reflects disciplined management and a durable business model. What I personally like about ADP is how boring it looks on the surface. There is no hype. No dramatic product launches, no dependency on consumer trends. Yet beneath that boring exterior is a machine that compounds value quietly and relentlessly. This is exactly the type of company that tends to outperform over long periods because it avoids the boom and bust cycles that destroy capital elsewhere. ADP also continues to invest in cloud-based platforms and data analytics, which helps it stay relevant as workplaces evolve. Remote work, hybrid models, and global teams all increase complexity, and complexity is good for ADP. The more complicated payroll and compliance become, the more valuable ADP's expertise becomes. If you are building a portfolio designed to last decades, ADP fits beautifully as a core holding. It offers stability, predictable growth, rising dividends, and a moat that only gets stronger over time. This is the kind of stock you can own through recessions, bull markets, and everything in between without losing sleep. And before we move on to the next stock, I want to quickly share a message from today's sponsor. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The second stock is NextEra Energy, ticker symbol NEE. NextEra Energy is not just another utility company. It is the largest producer of wind and solar energy in the world, and at the same time it owns one of the most stable and well-run regulated utility businesses in the United States. That combination is what makes NextEra so unique and so powerful as a long-term investment. To understand why NextEra matters, you first have to understand how rare it is to find a company that blends stability with growth this effectively. Traditional utilities are known for predictable cash flows but limited growth. Renewable energy companies often offer growth but lack stability and consistent profitability. NextEra sits at the intersection of both. Through its regulated utility subsidiary, Florida Power and Light, NextEra serves millions of customers in one of the fastest-growing states in the country. Florida's population growth continues to drive rising electricity demand year after year. This gives NextEra a dependable and growing revenue base that is supported by long-term rate structures and regulatory frameworks. At the same time, NextEra Energy Resources is the company's renewable energy arm, and this is where the real long-term growth engine lives. NextEra has spent decades building expertise, scale, and infrastructure in wind, solar, and energy storage. It did not jump into renewables as a trend. It built this business early, patiently, and strategically. What gives NextEra a durable moat is its scale and execution. Developing renewable projects requires massive upfront capital, regulatory approvals, land access, grid connections, and operational expertise. NextEra has already done this at a scale that very few competitors can match. This allows it to develop projects more efficiently and at lower costs than smaller players. Another key advantage is that renewable energy is no longer just about environmental policy, it is increasingly about economics. Wind and solar are now among the lowest cost sources of new power generation, as utilities and corporations look to lock in long-term energy prices and reduce volatility. NextEra's renewable portfolio becomes even more attractive. From a financial perspective, NextEra has delivered consistent earnings growth well above the average utility. It has also grown its dividend at a faster pace than most of its peers, while still maintaining a payout ratio that supports reinvestment. This balance between returning capital to shareholders and funding future growth is a big reason long-term investors are drawn to the stock. One thing I personally respect about NextEra is management's long-term mindset. The company regularly lays out multi-year growth plans and then actually executes on them. That kind of credibility matters, especially in capital-intensive industries where mistakes can be extremely costly. NextEra is also positioned to benefit from long-term electrification trends. Electric vehicles, data centers, and population growth all increase electricity demand. At the same time, grid modernization and energy storage become more important. NextEra is investing across all of these areas, which helps future-proof the business. It is also worth noting that regulated utilities like NextEra benefit from inflation pass-through mechanisms. Higher costs can often be reflected in regulated rates over time, which helps protect margins. That makes NextEra more resilient in different macro environments compared to many other sectors. For investors thinking in decades rather than quarters, NextEra offers a compelling mix of defensive characteristics and structural growth. It is not dependent on consumer sentiment or discretionary spending. People and businesses need electricity regardless of economic conditions. That demand only increases over time. In my view, NextEra fits perfectly into a buy and hold forever framework because it aligns with unavoidable long-term trends. Population growth, electrification, renewable energy adoption, and grid investment are not going away. NextEra is not trying to predict the future, it is already building it. This is the kind of company that quietly compounds value while paying you to wait, and over long periods, that combination can be incredibly powerful. That brings us to the third and final stock on this list, and this one plays a critical role in the digital backbone of the modern economy. The final stock is Digital Realty Trust, ticker symbol DLR. Digital Realty Trust is one of the largest owners and operators of data centers in the world. Data centers are the physical infrastructure that house servers, networking equipment, and storage systems that power everything from cloud platforms to financial systems to streaming services. If data is the oil of the digital economy, data centers are the refineries. What makes Digital Realty especially compelling as a buy and hold forever stock is the combination of real assets, long-term contracts, and structural demand growth. This is not a speculative technology play. It is a real estate business with highly specialized properties that are increasingly essential to how the global economy operates. To understand why digital realty matters, consider how data usage has evolved. Every year, the world generates exponentially more data. Cloud adoption continues to expand. Artificial intelligence requires massive computing power. Video streaming, online gaming, remote work, and digital payments all rely on secure, reliable, and geographically distributed data centers. These trends are not cyclical. They are secular and long-term. Digital Realty benefits from this demand through long-term leases with high-quality customers. Many of its tenants are large enterprises, cloud providers, and technology companies that need guaranteed uptime and security. Once a customer installs its infrastructure in a data center, moving it is expensive, disruptive, and risky. That creates high switching costs similar to what we saw with ADP, but in physical infrastructure form. Another key advantage for Digital Realty is scale. Operating data centers efficiently requires enormous capital investment, technical expertise, and global reach. Digital Realty owns facilities across North America, Europe, Asia, and other key markets. This allows customers to co-locate their infrastructure in multiple regions under a single provider, which is extremely valuable for global operations. From a real estate perspective, data centers are fundamentally different from traditional office or retail properties. They are mission-critical facilities with specialized power, cooling, and connectivity requirements. That specialization limits competition and makes these assets harder to replicate. You cannot simply convert an old office building into a high-performance data center without massive investment. Financially, Digital Realty operates as a real estate investment trust, which means it is structured to distribute a significant portion of its cash flow to shareholders through dividends. For long-term investors, this creates a steady income stream while still allowing exposure to growth. Digital Realty has a long history of paying and growing its dividend, supported by recurring rental income. One concern investors sometimes raise is interest rates, since REITs can be sensitive to higher borrowing costs. That is a fair point, but in the case of Digital Realty, the long-term demand drivers are powerful enough to offset short-term rate cycles. Data growth does not pause because interest rates rise. In fact, many customers sign long-term leases that provide visibility into future cash flows. Digital Realty also benefits from the trend toward hybrid and multi-cloud strategies. Companies are increasingly spreading workloads across multiple providers and locations for redundancy, performance, and security. That increases demand for colocation facilities that sit at the intersection of networks and cloud platforms. Digital Realty is positioned exactly there. What I personally like about Digital Realty is how it bridges the gap between technology and real assets. You are not betting on which software platform wins or which application goes viral. You are owning the infrastructure that all of them rely on. Historically, owning the picks and shovels of a gold rush has often been more profitable than chasing individual miners. Over time, as artificial intelligence workloads grow more complex and data-intensive, the need for reliable, high-density data centers will only increase. Power availability, connectivity, and scale will become even more valuable. Digital Realty has spent years building these capabilities, and that long-term investment is now paying off. When you step back and look at Digital Realty as a forever stock, it checks many of the same boxes as the other companies in this video. It has a durable moat, recurring revenue, long-term contracts, and exposure to unstoppable secular trends. It also adds diversification, since it behaves differently from traditional equities while still offering growth. Taken together, these three stocks represent different pillars of the modern economy. ADP supports the global workforce. NextEra Energy powers homes, businesses, and the transition to cleaner energy. Digital Realty underpins the digital infrastructure that connects everything. None of them rely on hype. All of them rely on necessity. That is why I believe these are the types of businesses you can buy, hold, and let compound over decades. Markets will fluctuate. Headlines will change. But companies that solve essential problems and do so at scale tend to endure. Before we wrap up, I want to leave you with a question. Which of these three businesses do you think has the strongest long-term competitive advantage, the payroll and workforce dominance of ADP, the regulated and renewable energy scale of NextEra Energy, or the digital infrastructure moat of Digital Realty Trust? Let me know your thoughts in the comments, and I would love to hear how you are thinking about long-term investing. And if you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.